If I had $1 million and I believed an economic collapse was coming, I would not do what most people think I would do. I would not buy gold and bury it in my backyard. I would not stuff cash in a safe. I would not panic and move everything to some offshore account. Those are the strategies of amateurs who watch too many movies about financial disasters. I have spent over 4 decades in banking. I have managed risk at the highest levels during the worst financial crises of modern times. I was in the room when decisions were being made that would determine whether the global financial system survived or collapsed. And I learned something that most people never understand. Protecting wealth during economic turmoil is not about finding the one magic asset that goes up when everything else goes down. It is about building a portfolio that can survive multiple scenarios, any one of which could unfold. Let me tell you what I saw during the 2008 crisis, because it is relevant to how you should think about protecting your wealth. I watched institutions that had survived for over a century collapse in a matter of days. I watched credit markets freeze completely, meaning companies could not borrow money to make payroll. I watched money market funds break the buck, meaning investments that people thought were completely safe suddenly were not. I watched the entire financial system come within hours of complete collapse. The people who survived that crisis financially were not the ones who made perfect predictions. They were the ones who had built resilience into their portfolios before the crisis began. They had diversification. They had liquidity. They had positions that performed differently under different scenarios. They were not trying to time the crisis or predict its exact form. They were prepared for multiple possibilities. The problem with most protection strategies is that they assume you know exactly what kind of collapse is coming. But you do not know, nobody knows. Economic collapse can take many forms. It can be deflationary, where asset prices crash and cash becomes king. It can be inflationary, where the currency loses value and hard assets soar. It can be a credit crisis where the banking system freezes. It can be a sovereign debt crisis where government bonds become worthless. It can be a combination of several of these at once. If you position for only one scenario and a different one unfolds, your protection strategy becomes your destruction strategy. The people who bought gold expecting inflation and got deflation instead watched their gold decline while their debt stayed fixed. The people who held long-term bonds expecting deflation and got inflation instead watched their purchasing power evaporate. The people who held cash expecting a credit crisis and got currency devaluation instead lost everything. This is why my approach to protecting $1 million from economic collapse is not about making one big bet. It is about building resilience across multiple scenarios. It is about ensuring that no matter what happens, you survive with enough capital to rebuild and take advantage of opportunities on the other side. Let me walk you through exactly how I would allocate $1 million if I believed serious economic turmoil was coming. This is not a theoretical exercise. This is the framework I would actually use. The first allocation is $250,000, or 25% of the portfolio, into short-term treasury bills and cash equivalents. This is your liquidity foundation. This is the money that absolutely cannot be at risk under any circumstances. I cannot overemphasize how important this allocation is. During every financial crisis I have witnessed, the people who suffered most were those who were forced to sell assets at the worst possible time. They needed cash for living expenses. They needed cash for margin calls. They needed cash for emergencies. And because they did not have enough liquid assets, they had to sell their stocks, their bonds, their real estate at distressed prices. This forced selling is devastating. You lock in losses permanently. You miss the eventual recovery. You destroy wealth that took years or decades to accumulate. The only way to avoid this fate is to have enough liquidity that you are never forced to sell. Short. Term Treasury bills are the safest financial assets in the world. They mature in a few months. They are backed by the full faith and credit of the United States government. Even in the worst financial crises, Treasury bills have held their value and remained liquid. During 2008, when everything else was collapsing, Treasury bills were the safe haven that everyone fled to. I remember the weeks after Lehman Brothers failed. Credit markets were frozen. Banks would not lend to each other. Corporate bonds were selling at distressed prices. But Treasury bills remained liquid. You could buy them. You could sell them. They were the only thing that still worked normally. Cash equivalents include money market funds that invest only in government securities, not money market funds that hold commercial paper or corporate obligations. Those can have problems during crises. In 2008, one of the largest money market funds broke the buck because it held Lehman Brothers commercial paper. Only funds holding exclusively government securities provide the safety you need. Why 25%? Because this gives you roughly 7 years of living expenses if you spend $40,000 per year. 7 years is long enough to wait out even a severe and prolonged economic downturn. You will never be forced to sell other assets at distressed prices because you need cash. You can be patient. You can wait for recovery. That patience is worth its weight in gold. Some people will say this is too conservative. 25% earning minimal returns seems like a waste when markets are doing well. But I am not optimizing for returns when markets are doing well. I am optimizing for survival when markets are doing badly, and survival requires liquidity. The second allocation is $200,000 or 20% of the portfolio into Treasury bonds of varying maturities. This provides protection against deflationary collapse, which is one of the most devastating scenarios for investors. In a deflationary collapse, asset prices crash, stocks fall, real estate falls, commodities fall, but high. Quality bonds rise because interest rates fall to zero and the fixed payments from bonds become more valuable. This happened in Japan after their bubble burst. It happened in the United States during the Great Depression. Bonds were one of the few assets that provided positive returns. I would spread this allocation across different maturities, about 5% in 2-year notes for stability, about 10% in 10-year notes for some duration, about 5% in 30-year bonds for maximum deflation protection. The longer the maturity, the more the bond rises when interest rates fall, but also the more it falls when interest rates rise. The spread across maturities balances these risks. Treasury bonds also provide income. Even if yields are low, the interest payments provide cash flow that can be used for living expenses or reinvested. During a prolonged downturn, that steady income is psychologically valuable. It reminds you that your portfolio is working even when asset prices are not rising. The third allocation is $150,000, or 15% of the portfolio, into physical gold and precious metals. This provides protection against currency collapse and loss of confidence in financial institutions. Gold is the asset that has survived everything. Empires have risen and fallen. Currencies have been created and destroyed. Financial systems have collapsed and been rebuilt. Through all of it, gold has maintained value. When people lose faith in paper money, when they lose faith in banks, when they lose faith in governments, they turn to gold. I have been skeptical of gold for most of my career. It produces nothing. It pays no dividends. It just sits there. But I have come to appreciate its role as insurance against the unthinkable. When the financial system is functioning normally, gold is a mediocre investment. When the financial system is breaking down, gold is invaluable. I would hold this gold in physical form, either coins or bars stored in a secure location, or in ETFs backed by physical gold held in allocated storage. I would not hold gold mining stocks as a substitute. Mining stocks are equities. They have operational risk, management risk, financial risk, and a true collapse. Gold mining stocks often fall even as gold rises because the equity market decline overwhelms the commodity price increase. Some people advocate holding much more than 15% in gold. They envision apocalyptic scenarios where gold becomes the only money, but those scenarios are extremely unlikely, and if they occur, the amount of gold you hold will be the least of your problems. 15% is enough to provide meaningful protection without betting the entire portfolio on one outcome. The fourth allocation is $150,000 or 15% of the portfolio into high-quality dividend-paying stocks. This provides protection against inflation and ensures participation in eventual economic recovery. Even in severe economic downturns, the best companies survive. They continue operating. They continue generating profits. They continue paying dividends. Coca-Cola paid dividends through the Great Depression. Johnson & Johnson paid dividends through every recession of the past century. These companies have weathered every storm because they sell products that people need regardless of economic conditions. I want to tell you about what I observed during the 2008 crisis regarding dividend stocks. Yes, their prices fell along with everything else, but the best companies continued paying their dividends throughout the crisis. Those dividend payments provided income to investors who needed it. They provided cash that could be reinvested at depressed prices. And psychologically, they provided reassurance that the companies were still functioning, still profitable, still returning capital to shareholders. The investors who reinvested those dividends at the market lows made extraordinary returns when markets recovered. They were buying shares at prices that seemed unthinkably low. Those shares eventually recovered and more. The dividends that seemed small at the time grew into substantial positions as the prices appreciated. I would focus on companies with specific characteristics, strong balance sheets with minimal debt, essential products or services that people buy even in recessions, long histories of paying and increasing dividends through multiple economic cycles, dominant market positions that provide pricing power. Let me be specific about what I mean by essential products. Food, beverages, household products, personal care items, medications, electricity, water. These are things people buy regardless of economic conditions. They might cut back on restaurants and vacations and new cars, but they still buy toothpaste and toilet paper and medicine. Consumer staples companies fit this profile. Well, people still buy food, beverages, household products, and personal care items during recessions. Then it might trade down to cheaper brands, but they still buy. Utility companies also fit well. People still need electricity, water, and gas. Regardless of the economy, healthcare companies benefit from non-discretionary demand. People still need medications and medical care, even when times are tough. 15% in high-quality dividend stocks provides exposure to real assets that can grow with inflation while generating income during the holding period. When the economy eventually recovers, these stocks will participate in the recovery. You will not be left behind holding only defensive assets that lag when conditions improve. The fifth allocation is $100,000 or 10% of the portfolio into Treasury inflation, protected securities, also known as TIPS. This provides explicit protection against inflation, which is one of the ways governments typically respond to economic crises. When governments face crises, they often respond by spending money they do not have. They run large deficits, they print money to finance those deficits. The result is often inflation, sometimes severe inflation. TIPS protect against this because their principal value adjusts upward with inflation. If inflation spikes, your TIPS increase in value to compensate. TIPS are particularly valuable because they provide protection while maintaining safety. They are still Treasury securities backed by the full faith and credit of the United States government. They still pay interest. They are still highly liquid. But unlike regular Treasury bonds, they do not get destroyed by inflation. The 10% allocation to TIPS complements the 20% in regular Treasury bonds. If deflation occurs, the regular Treasury bonds will rise in value. If inflation occurs, the TIPS will rise in value. Either way, you have protection. The sixth allocation is $100,000, or 10% of the portfolio, into foreign currency and international assets. This provides protection against a collapse specific to the United States while maintaining exposure to global economic activity. Most Americans have almost all their assets denominated in dollars. Their stocks are American stocks. Their bonds are American bonds. Their real estate is American real estate. Their bank accounts are in American banks. If something happens specifically to the United States, whether a political crisis, a sovereign debt crisis, or a loss of reserve currency status, these investors are completely exposed. This concentration risk is usually invisible because the United States has been stable for so long. People assume that what has been stable will remain stable. But history teaches otherwise. The British pound was the world's reserve currency for over a century. Then it was not. The transition was painful for those who had all their wealth in sterling. I am not predicting that the dollar will lose its reserve currency status. That remains unlikely in the near term, but unlikely is not impossible, and the consequences would be severe enough that some protection is warranted. I would diversify internationally, but carefully. I would hold Swiss francs, which have historically been a safe haven currency backed by a stable, well-managed economy. Switzerland has low debt, sound fiscal policy, and a long history of political neutrality. The Swiss franc tends to appreciate during global crises as people seek safety. I would hold some exposure to developed market international stocks, particularly in countries with strong fiscal positions and stable governments. Singapore, Norway, Australia. Countries that have commodities, savings, and responsible governance. I would avoid emerging markets, which typically suffer even more than the United States during global crises. Emerging market stocks and currencies often collapse when risk aversion spikes. The international allocation is modest at 10%, because I still believe the United States is the safest large economy in the world. But 10% provides meaningful protection. If I am wrong about that, and even if I am right, international diversification reduces overall portfolio volatility because markets do not move in perfect correlation. The seventh allocation is $50,000, or 5% of the portfolio, into alternative investments that might benefit from disruption. This is the speculative portion that could generate significant returns if specific scenarios unfold. This 5% could go into Bitcoin or other cryptocurrencies if you believe that digital assets might benefit from loss of confidence in traditional financial systems. It could go into commodities like oil or agricultural products if you believe supply disruptions are likely. It could go into put options on the stock market if you believe a crash is imminent. I keep this allocation small because these are speculative bets. They could generate enormous returns if your specific prediction proves correct. But they could also lose most or all of their value if your prediction is wrong. 5% is enough to benefit meaningfully if you are right, without devastating your portfolio if you are wrong. Let me now explain the thinking behind this overall allocation, because understanding the logic will help you adapt it to your own situation. The portfolio is designed to survive and protect capital across multiple scenarios. In a deflationary crash, the Treasury bills and Treasury bonds will perform well while the gold and stocks decline, resulting in a net portfolio that loses less than the market. In an inflationary crisis, the gold, tips, and dividend stocks will perform well while the Treasury bonds decline, again resulting in a net portfolio that protects purchasing power. In a credit crisis, the Treasury bills and bonds will hold their value while other assets become illiquid. In a currency crisis, the gold and foreign assets will provide protection. No single scenario wipes out the portfolio. That is the key insight. By diversifying across assets that perform differently in different scenarios, you ensure survival regardless of what happens. You sacrifice some upside in any particular scenario, but you eliminate the risk of catastrophic loss. The portfolio is also designed to be maintained without constant trading or monitoring. Once you establish these allocations, you can largely leave them alone. You do not need to time markets or predict which scenario will unfold. You just need to rebalance occasionally, perhaps once a year, to maintain your target allocations. Let me talk about some practical considerations for implementing this strategy. First, do not try to implement this all at once. If you currently have $1 million in stocks and you want to move to this defensive allocation, do it gradually over several months. Selling large positions quickly can result in poor execution and tax consequences. Spread your transitions over time. I have seen investors panic and try to restructure their entire portfolios in a single day. They sell at the lows because everyone else is selling at the lows. They pay huge transaction costs. They trigger massive tax liabilities. They would have been better off moving gradually, even if it meant holding positions they wanted to sell for a few extra months. Second, consider tax. Advantaged accounts carefully. If you have retirement accounts like IRAs or 401k plans, those are good places to hold the bonds and tips because the interest income is sheltered from taxes. Taxable accounts are better for stocks that pay qualified dividends, taxed at lower rates, and for assets you might want to sell tactically. Tax efficiency matters more than most people realize, especially with a large portfolio like $1 million. The difference between paying ordinary income tax rates and capital gains rates can amount to tens of thousands of dollars per year. Structure your holdings to minimize taxes within the constraints of your overall protection strategy. Third, keep your physical gold in a secure location. A safe deposit box at a bank works, but be aware that safe deposit boxes are not insured by the government and could be inaccessible if the bank fails or if there is a bank holiday. A home safe that is fireproof and well. Hidden is another option. Whatever you choose, make sure someone you trust knows where it is. I have heard stories of people who hid gold so well that their families could not find it after they passed away. That defeats the entire purpose of having gold for protection. Document the location. Share that documentation with someone you trust. Make sure the gold can actually be accessed when it is needed. Fourth, establish relationships with multiple financial institutions. Do not keep all your assets at one bank or one brokerage. If an institution fails, having accounts elsewhere ensures you maintain access to at least some of your money. This diversification of institutions is as important as diversification of assets. During the 2008 crisis, some brokerage customers had their accounts frozen for weeks during institutional failures. They could not access their money. They could not make trades. They were helpless. The customers who had accounts at multiple institutions maintained access to at least some of their funds. Fifth, maintain some currency outside the banking system. A few $1,000s in cash stored securely at home provides options if ATMs stop working or banks closed temporarily. During the Cyprus banking crisis in 2013, people who had cash outside the banking system were able to buy essentials while others could not access their accounts. This is not about preparing for the apocalypse. It is about having options when systems fail temporarily. ATMs go down, banks have technical problems. In extreme cases, there are bank holidays where all banks are closed. Having some cash on hand is simply prudent. Now let me address some common questions and objections to this strategy. Some people will say this is too conservative, that holding 25% in treasury bills and 20% in bonds means giving up too much return potential. To them I say, what is your alternative? If you believe economic collapse is coming, why would you want aggressive growth assets that will be devastated by that collapse? The whole point of this strategy is protection, not growth. You can pursue growth when the crisis has passed and opportunities emerge. Some people will say this is not conservative enough, that I should hold more in gold or more in cash. To them I say, even in severe crises, the world does not end. The economy eventually recovers. If you are holding 80% in gold and cash and the economy recovers faster than expected, you will miss the recovery entirely. You need enough equity exposure to participate when conditions improve. Some people will say that trying to protect against economic collapse is foolish, that these events are so rare and unpredictable that you should just stay invested in a normal portfolio. To them I say, tell that to the people who lost everything in 2008. Tell that to the retirees in Cyprus who had their savings confiscated. Tell that to the people in Argentina and Venezuela who watched their currencies become worthless. Economic collapses are rare, but they are not impossible. And when they happen, the consequences are devastating. Some people will ask how to know when the crisis is over and when to return to a normal allocation. This is a difficult question because crises do not announce their endings. My advice is to stay defensive until it is obvious that conditions have normalized, which usually means waiting longer than you want to. The biggest mistake people make is returning to aggressive allocations too early, only to be caught by a second wave of the crisis. Let me share some historical perspective on how this kind of defensive portfolio would have performed during past crises. During the Great Depression, a portfolio like this would have preserved most of its value. The treasury bonds would have appreciated significantly as interest rates fell. The gold would have held its value even as the government devalued the dollar. The high-quality dividend stocks would have declined, but much less than the market average, and they would have continued paying dividends. The overall portfolio might have declined 20 or 30% when the market declined 90%. Think about what that difference means. An investor who was fully invested in stocks lost 90% of their wealth. They would have needed their portfolio to increase by 900% just to get back to where they started. That takes decades, if it ever happens at all. An investor with a defensive portfolio who lost 20% needed their portfolio to increase by only 25% to recover. That could happen in a year or two once the crisis passed. During the stagflation of the 1970s, the golden tips equivalent investments would have appreciated significantly. Gold increased from $35 an ounce to over $800 an ounce during that decade. The treasury bonds would have declined, but not catastrophically, because you would have been in shorter maturities. The dividend stocks would have provided income that at least partially offset inflation. The overall portfolio would have roughly maintained purchasing power when the market delivered negative real returns for a decade. The 1970s taught an important lesson about inflation that many investors today have forgotten. When inflation spikes, traditional financial assets like stocks and bonds can decline in real terms even if they rise in nominal terms. A bond paying 5% when inflation is 10% is losing you money. A stock that rises 5% when inflation is 10% is losing you money. Only assets that rise with inflation, like gold and tips, truly protect purchasing power. During the 2008 financial crisis, the Treasury bills and bonds would have appreciated as the flight to safety drove yields down. The 10-year Treasury yield fell from about 4% to under 2% during the crisis, meaning bond prices rose significantly. The gold would have initially declined, but then recovered and appreciated significantly over the following years, ultimately more than tripling in price. The dividend stocks would have declined but recovered relatively quickly. The overall portfolio would have declined perhaps 15% when the market declined 50%. I was there during 2008. I saw portfolios that had taken decades to build get destroyed in months. I saw retirement plans become worthless. I saw people who thought they were wealthy discover they had nothing. And I saw the few who were prepared, who had defensive allocations, who had liquidity, emerge from the crisis with their wealth largely intact. In each case, the defensive portfolio did not generate spectacular returns, but it survived. It protected capital. It allowed the investor to emerge from the crisis with enough resources to take advantage of opportunities on the other side. That is the goal. Not getting rich during a crisis, surviving the crisis so you can get rich afterward. Let me close with some thoughts on the psychological aspects of protecting wealth during economic turmoil. The hardest part of this strategy is not the allocation decisions. It is the emotional discipline required to maintain the strategy when things get difficult. When markets are crashing and fear is everywhere, you will be tempted to sell everything and go to cash. When markets are recovering and everyone else is making money, you will be tempted to abandon your defensive positioning and chase returns. Both temptations must be resisted. The whole point of establishing this allocation in advance is so that you do not have to make decisions during periods of high emotion. The decisions have already been made. Your job is simply to stick with the plan. This requires understanding that the portfolio is designed for the long term, not the short term. In any given year, the portfolio might underperform. It might lag a bull market. It might not drop as much as you expected during a bear market. That is fine. The portfolio is not optimized for any single year. It is optimized for survival across multiple scenarios over multiple years. It also requires accepting that you will never optimize perfectly. In hindsight, you will always be able to identify assets you should have held more of or less of. If deflation occurs, you will wish you had held more treasury bonds. If inflation occurs, you will wish you had held more gold. If the crisis never comes, you will wish you had held more stocks. This is unavoidable. The goal is not to be perfect. The goal is to be resilient. Finally, it requires maintaining perspective on what really matters. $1 million is a lot of money. Protecting it is important, but money is ultimately just a tool for living a good life. Even if you lose some of it, even if your protection strategy is not perfect, you will likely be fine. The stress and anxiety of trying to protect every dollar can be worse than the financial losses themselves. The best protection strategy is one that you can implement, maintain, and live with. If a strategy makes you anxious, if it keeps you up at night, if it causes you to check your portfolio constantly, then it is not the right strategy for you, regardless of how optimal it might be on paper. That is how I would protect $1 million from economic collapse. 25% in treasury bills and cash for liquidity, 20% in treasury bonds for deflation protection, 15% in gold for currency crisis protection, 15% in high-quality dividend stocks for inflation protection and recovery participation, 10% in tips for explicit inflation protection, 10% in foreign assets for United States specific risk protection, 5% in alternative investments for speculative upside. This allocation is not perfect. No allocation is perfect, but it is resilient. It will survive multiple scenarios. It will protect capital when protection is most needed, and it will allow you to emerge from whatever crisis comes with enough resources to rebuild and thrive. That's what protecting wealth really means. Not avoiding all losses, not predicting the future perfectly. You're just surviving, maintaining optionality, and living to invest another day. If you can do that, you will ultimately be fine regardless of what economic turmoil the world throws at you. The $1 million you have today represents years of work, years of saving, years of discipline. It deserves to be protected, not with reckless speculation on what kind of crisis might come, not with paralysis that keeps everything in cash, earning nothing, but with thoughtful diversification across assets that will perform differently under different scenarios. I have seen fortunes made and lost during economic crises. The fortunes that were made went to people who were prepared, who had liquidity when others did not, who could buy when others were forced to sell. The fortunes that were lost went to people who were overconfident, who were concentrated in risky assets, who had no plan for when things went wrong. Do not be the person who loses their fortune. Be the person who is prepared. Build your defensive allocation now, while you still can, while markets are functioning normally, while there is no panic forcing your hand. The time to prepare for a storm is before it arrives, not when the rain is already falling. That is how I would protect $1 million from economic collapse. I hope you never need these protections. I hope the collapse never comes, but if it does come, I hope you are ready.